If you go into gold, like you rewind probably 2 years, so Canada, North American gold, like if we look at the actual ASX companies, it was going to be the next best thing.
It just goes to show that maybe a company's advantages in a particular location aren't necessarily transferable to a different workforce and a different location and potentially different geology types. Been for those people invested in uranium, it's been always a story of next year for about 10 years or something, which has been frustrating. But that said, if you look at it, the fundamentals of the market look as good as they have, in the last 10 years. Our interest is also in the bit shorter term in, a bit of a squeeze, for the lack of a better term, that looks like it's shaping up with the Sprott Physical Uranium Trust in the physical market. And then there's another fund out of Europe just started up, which also wants to buy pounds in the physical market. So you could get that confluence of factors where you've got the positive long-term story and then a shorter term spike added, which is why we've got a relatively high weighting there at the minute.
Right, g'day Money Minders. We're bringing a tell you what, if you're an AFR subscriber, you would have read a sensational article with this great looking bloke in it last week, Matthew Lakesford from Terra Capital. Mate, next time you want to do an article, mate, you come to us first. We're the new top dogs in mining, mate. Welcome to Money and Mind, Cobber.
Thank you guys. Thanks for having me. What an intro.
How long is that going to last? You're going to get shit about that article for? That's
It's been happening a lot. I hope it ends soon.
Right, Trav, Trav's off running some errands, mate. You got me and JD today. So, mate, thanks very much for coming on. Great to catch up. Thanks for allowing Juju to create such a great event for the Gold Series, mate.
It was good.
How many free tickets did Terra Capital get since you sleep in the same bed with the organiser, mate? What sort of privileges did you get?
Mate, you'd be surprised. Given we're married, but we, myself and we had Dylan from the office, our head of research, in as well. So it was a great little event.
Very good, mate. Okay, let's roll in. We always like to start with everyone's got a bit of underlying, I guess, thematic strategy to how your fund works. Terra Capital, you're based in Sydney. Give us the scope, mate. What are you invested in? What's the go? What's your strategy?
Yeah, so we are a long-only global natural resources equities fund. That's pretty broad. It means basically we invest predominantly on the ASX and the TSX, Toronto Stock Exchange, given that's the other major mining index besides the ASX for mid caps, small caps, and I guess and large caps there too. But I mean, I guess you also get on the London Stock Exchange a few large caps. Same with New York, but we're mostly ASX and TSX. And we are all cap in our market cap range. We'll do small miners post discovery exploration. So they may had that initial drill hit, but then they're expanding the resource or whatever the case may be. And then we're also in producers and developers and across the whole spectrum. We've been doing it in both Jeremy and I were doing the same type of investing in the same space before being at Terra. He worked at a hedge fund in London. I was at a mid-tier specializing in the sector. And then, Jeremy set up Terra in 2010. So the flagship's been running for 13 years as of 30 June just passed. And then we've got a green metals fund as well, which is similar to the natural resources strategy, just no fossil fuels in there.
So what drew you to, I guess, mining? You're based on the East Coast, obviously. There's all the hot air and bloody everything coming out of Perth, mate. She's all going West Perth and Subiaco if you want a bit of liquidity sometimes, I guess. But from being based over East, what draws you to predominantly invest in mining?
Yeah, I am from Perth originally. Grew up there, went to uni there, and so is Jeremy, actually. So a lot of the people in the industry, we've known for a long time, which can be handy. It's also good just to know the places, and all the brokers, et cetera, et cetera. So yeah, we there's a lot. We head over to Perth a lot. There's obviously a whole host of companies there. So we're over there a lot, and Also head out to site. But then also, if you're really choosing this as your profession and something you're doing, and you're looking at mining and energy as an equity sector, you've got to be global in our opinion, because there's some things that the Canadians are better at than the Aussies, and vice versa. And some commodities you can get better exposure over there than you can here, in our opinion. So yeah, being global is one thing that's probably different from most other natural resources funds in Australia. I mean, there's not many of us, full stop, but I think we've got over half the fund in TSX equities at the minute.
Matty, you've said not too long ago that resources as a sector are cheap versus other sectors, in the ASX and more broadly. Why do you sort of think that is, just broadly speaking, to start with? And then where do you think we are at in the cycle, given the sort of future we're kind of seeing for the next 10 years in the resource space?
JD's going to hold you accountable for everything you've said in history today, mate. He's done his research on you.
Yeah, recorded in time. Anyway, no, but I mean, I don't think people can argue at the metrics of whether or not the sector is cheap or not. You got like the major miners 4-5 times earnings. You compare that to any other sector where you got companies trading on 20 and 30 times, that's relatively cheap on that basis. But then because of the underinvestment, and this is what every resources investor or commentator will say, there's been an underinvestment into new supply of commodities through investment into mining projects, and so therefore, as you look out to 2024, 5, 6, the cupboard is pretty bare in terms of new projects that can come on and satiate the demand, and that's just normal demand that ticks along, say, at GDP. But if you add on top the decarbonisation demand, green demand, if you want to call it that, well, then there's some commodities that look particularly compelling. So I think that from a low earnings multiple basis, you can have those earnings multiples normalize. The mining industry in a bit more of a positive market will trade on, more like 8 to 12 times. So you could have that multiple normalization or expansion, whatever you want to call it. But you could also have that in a rising commodity price environment as well. So, which we think will happen for some commodities. So I think it's pretty exciting at the moment. And, you guys have on the talked about all the M&A that's happening, and that's just the Aussie stuff. There's been a whole host of other things that have happened internationally that are more. I mean, there's been a bunch of gold, but there's also been a bunch of gold interest in copper miners or gold interest in gold miners that have more copper, and then the rest of them are kind of decarbonisation focused. Whether that's Teck, Glencore, copper miners expanding production. BHP's invested now a couple of $100 million into Filo Mining, which is TSX listed. So it's happening, and I think the industry incumbents are seeing what's on the horizon. They know how long it takes to develop these mines, how hard it is to permit them, and so they're at the moment sitting there saying, well, why don't I buy something which is already defined. And save ourselves the trouble of that, and hopefully shorten the length of time for them to add those commodities to their future production. The thing about M&A though is that it doesn't change the overall pipeline. It's just these assets are just changing hands. There hasn't been those big capital outlays into the development of new projects. So that's still ahead of us. And mining cycles die of overinvestment, and that's certainly not where we're at now. We're more at the beginning of the cycle, we think, than the end.
There's not much rocks getting produced from all this M&A sometimes, is there? It's all
exactly.
You also sort of reference a non-cyclical nature of the demand that we're going to see in some of these battery type metals. I'm kind of keen to hear how you guys internally factor that in. Is it like just in your commodity price forecasts at Terra?
Yeah, so that's a good point, and people in cyclical industries always say they're not cyclical, I guess, but I think there is, because the green demand growth and the government funding that's available in terms, like the Inflation Reduction Act in the US, Repower EU, which has set aside huge swathes of potential funding for clean energy minerals and components to be produced within the EU. It does add some that funding is not really economically sensitive. It's more about reindustrializing the West, I guess, because of China's control over these critical minerals. So that is something that, the US just wants rare earths to be, for instance, rare earths to be produced in US friendly locations. They're not super concerned about the economics of the projects they're funding. They just need the supply of those elements to come from places that are friendlier.
I want to hone in on this TSX Canada sort of big chunk of your portfolio, mate. And this might be a dumb question, but is it better to invest in a company in the TSX, or is it better to invest with an ASX company with a Canadian or North American asset? Is there any difference in how the whole markets work?
Yeah, I mean, as a general rule, I think assets are in the same location as the exchange will perform better because investors on that exchange will be, most ASX investors will be familiar with the typical mining jurisdictions in Australia. They'll be familiar with Kalgoorlie, and they'll be, familiar with the Pilbara, et cetera, et cetera. So it's easier to bring people on the journey. They know the other companies that have been successful there. But then again, in some commodities, I think Aussie mining executives have more experience and are just better at developing and producing from those types of projects. Lithium being key example at the minute. With Patriot and the like. It's all Aussie guys who went over and got that going. But then I guess taking a step back, there are other commodities that are better done, I think, or there are better options, I should say, on the TSX. In uranium, for example, the better companies are Athabasca companies, and they're listed on the TSX. Like, you've got, genuine high grade discoveries in small companies there. Like there's, your listeners probably haven't come across it, but it's called F3 now, Fission 3.0, which has got, 5 meter hits of 18% uranium, like a, proper juicy results. So, it's nice for us to have the option to express our commodity exposures in different jurisdictions.
Now, if you go into gold, like you rewind probably 2 years, so Canada, North American gold, like if we look at the actual ASX companies, it was going to be like, the next best thing. Or Teco went up to 20 cents, they're back to 2 cents. And you had, Silver Lake got exposure there. You got Red Lake,
Evolution.
Newcrest with Bruce Jack, and obviously the St. Barbara saga. Northern Star were getting extra exposure over there, but
Evolution, Red Lake.
That flavour's just totally gone to shit. But you obviously think long term it's going to come back.
Well, I think it just goes to show that maybe a company's advantages in a particular location aren't necessarily transferable to a different workforce and a different location and potentially different geology types. So it's something to be aware of, I guess, and to be a little bit careful of. You don't typically see people from one jurisdiction go into someone else's backyard and do amazingly well. I mean, there are, of course, some exceptions, but something to be aware of. I would, but if I was going to invest in the Red Lake area, for example, in Canada, I'd probably prefer to do it with a management team who's worked there for their whole careers.
So when you say your 50% of your fund is over in, I guess, North America, is that saying the 50% is on the TSX or 50% is invested in companies that have operations based over there?
Yeah, good point. So that's listed on the TSX, and so the assets may be in South America, US, Canada, wherever. That's just where the listing is.
Yep.
And like I was saying, you can probably get better uranium exposure, silver exposure, and in our opinion, copper exposure at the moment on the TSX. Canadian mining executives are a bit more experienced in working in South America, for example, as well. So most of our South American companies, not that we've got heaps of them at the minute, but they're run by Canadian management teams. Just, same time zone, a bit closer. I don't know what it is. They've just got more experience there, and that's the way it's ended up.
Matt, putting aside for a moment the different sort of exposures you can get in North America and just focusing on the valuation sort of differentials that you're sort of expressed that you see on the TSX versus the ASX, what do you think is the catalyst for the change? Like, I think you in the past gave the example of a similar style gold deposit that is valued half as much in one versus the other.
That's the point. I think the Canadian market really has larger swings than the Aussie market. And I think that's driven by the fact that your Canadian investor has a bit wider range of sectors, I guess, they can go into. For instance, in the 2016 to 19, there was all the weed companies over there that sucked a lot of risk capital out of small cap miners. And then you had crypto, and you've got a bigger tech segment over there. And then, of course, they're closer to the US. So they'll play those exchanges as well. But by the same token, when commodities perform well and when mining companies are performing well, you get that weight of the US investors coming to the TSX. And so while that sector can be tougher on the downside, you also get far bigger valuations and far bigger multiples on the upside, on the upswing too. So it is a bit of a long game, and it's hard sometimes, if you're comparing, 1 million ounces in just outside of Kalgoorlie versus 1 million ounces just in Ontario. So both good mining jurisdictions, and the Canadian ones at half or 60% of the value. It's all well and good to identify that, but then what's going to make that change? And that's the more difficult thing, I guess.
Matt, we've touched on the M&A we're starting to see in the metals and mining space, it's like in particular in the big end of town. And let's take sort of copper as an example. It looks pretty clear that we're not seeing the price to incentivize new mines to come online, and we're just seeing the M&A like we spoke about. How long do you sort of think we need to see elevated prices before we start to see a company actually build a mine again?
Good question. I think, it's a few, some are pretty close. And so you probably don't need too long a period of time, probably 6 months or so. But if you look at the copper market and just how tight it is, I'd be surprised if we don't get record high copper prices I don't know exactly when it's going to happen, but sometime in the next year or two, we'll probably see record high copper prices. And so that'll impact all those companies, from those that look like they're going to be in the lower quartiles of cost of production down to those that are more leveraged with less high quality assets, I would say. So, that's a hard one. That's one of those predictions you want me to make where you're putting a date. What is it? Never put the date and a prediction on the same bit of paper.
Copper's
worth a go,
because copper it's so different to gold in terms of. It's hard to find the scale, isn't it, to justify building these plants? Like, I suppose not in every case. It's just there's not many snatch and grab copper mines like there are gold mines.
No, there's not as many kind of sitting there, resources defined, ready for the construction decision to be made. Yeah, I guess you're right. There are some pretty attractive ones on the TSX, which are bigger. They're in the $1 billion to $3 billion market cap range. But that doesn't mean they won't 3, 4, 5x. I think because there's that Filo Mining, which I mentioned. BHP's invested $100 million maybe 18 months ago, and then they just popped up again recently with another 70 or 90 million. And that deposit, Filo del Sol's had drill hits of 1,300 metres at 1.3% copper and 850 metres at 1.8% copper, like absolute belters. So they're there, and that project will be developed. There's companies like that one. There's another one, NGX, which They've got a very large, low-grade-ish porphyry. It's got a high-grade component of 0.8% copper, but then, they've had this discovery of 60 meters at 7.5% copper relatively nearby. So there are, if you have got the ability to invest globally, it just widens the lens of things you can look at. And copper's a pretty good example, I think.
Copper's interesting in terms of the fact that if the prices do go up a lot, because a lot of it, the supply is going to have to come from the big porphyries like the ones that you've just talked about, because to find a like a massive sulfide like a DeGrussa, for example, is obviously not the easiest thing to do. They don't come up too often. So there's definitely going to be a flurry of capital that is going to be rushed into this if this copper price increase transpires. It's been getting talked about for a while, but obviously depending on the recessionary and interest rate macro side of things, going to determine when that's going to happen.
Yeah, I think just on that quickly, and we're not macro investors, and probably should take everything I say here with a grain of salt. We're more kind of bottom up mining. That's our expertise. But China, if they do stimulate, that'll cover a lot of the sins of a North American, or more than cover the sins of a North American recession, I think, in terms of copper demand. So there is that to kind of hang our hats on in the short term, as everyone expects this recession.
On copper for just a moment longer, we've spoken on the Money of Mine team recently about another potential listing here, the Metals Acquisition Corp.
Oh, the SPAC.
Which I've heard Terra being referenced in as well.
Oh, the boys got their payday. They got their bloody payday, the billion that. They'd be loaded now.
Specifically on the financing and on the various streams and such that the company did to get this one off the ground. I'm keen to get your take on.
Yeah, I guess they did what they needed to do. I think all of the people involved would have preferred, including us, I guess, that it wasn't done in a SPAC, but that's the way it transpired, and it was done at a different time. So you can't completely blame them for that. I think all you want to do is just look at that asset, and Matty, you would know more, or you would have forgotten more about underground mining than I've ever known, but it is getting deep there, but it's also got reserves still in the 4 or 5% copper range. So I think while it won't be the easiest, I think it comes out, and given the dearth of copper producers on the ASX, how many there are, 4 only producers, I think it will compare pretty well. And so that's our interest. And so I think when they've got the New York Stock Exchange listing now, they'll dual list on the ASX, I think this second half of 23, and then it'll definitely be one to watch, because I think it should compare pretty favourably to the incumbent copper producers on the ASX.
So when you said, probably for listeners and myself, I won't lie, when you said you would have rather it not been a SPAC, but that's the way it transpired. Why did it transpire that way for the CSA transaction?
Yeah, I think the directors and the CEO, Mick McMullen, initially went, they thought that would be a good vehicle to use. At the time, I actually probably should ask them exactly how it came about like that. But I mean, at the time, SPACs were all the rage. So, like I said, you can't blame them for that. But now it's a bit complicated. So because we've got this New York listed stock, and I'd just prefer it be ASX listed on a mining exchange. But no, it doesn't change the asset. Doesn't change anything.
What do you say about that New South Wales area for copper? It seems like if there's going to be any copper flare up in Australia, it's going to be in that Cobar Basin and that sort of area.
Yeah, it's interesting, but like a lot of like DeGrussa, the area around DeGrussa now looks like Swiss cheese. People have been trying to find the follow up or the other lens or whatever the geological repetition, but it hasn't been found, and nothing in Cobar has been found that's as good as CSA mine. So, whoever's got CSA mine, I guess, kind of has the has the power in the area. But at the same time, it is exciting in terms of those polymetallic. If we get a good copper market, those companies I think will perform well.
Matt, on lithium now, we had a bit of anecdotal evidence in the last couple of weeks with Sweden sort of changing the structure of their fossil-free renewable goals for 20 or so years' time. I'm interested to sort of hear your thoughts, given it makes up a pretty large portion of the commodity weighting in the Green Metals Fund, how you view the sentiment changing toward uranium and nuclear power becoming more of a component of the energy mix.
Yeah, I mean, it's been, for those people invested in uranium, it's been always a story of next year for about 10 years or something, which has been frustrating. But that said, if you look at it, the fundamentals of the market look as good as they have, in the last 10 years. And we have that nice long-term story of countries wanting to generate carbon-free baseload power, and uranium's one of the only ways the only way they can do that, really. And it's a perfect complement to renewable energy sources. So that's a nice long-term story. Small modular reactors, I think that's all coming, albeit relatively slowly. Our interest is also in the bit shorter term in, a bit of a squeeze, for the lack of a better term, that looks like it's shaping up with the Sprott Physical Uranium Trust in the physical market. And then there's another fund out of Europe just started up, which also wants to buy pounds in the physical market. So you could get that confluence of factors where you've got the positive long-term story and then a shorter-term spike added, which is why we've got a relatively high weighting there at the minute. And then, spot prices kept on going up. Second half of the year is usually a bit better period for uranium price. But then again, I've been saying that now for years. So
Langers, I'm going to have to give you a compliment, mate, because JD's got all these notes and questions prepped, and Langers is just rolling them off like nothing here. So, mate, tell you what, very, very impressed with the knowledge you bring into the table here, mate.
We'll keep going with another one of my scripted questions. Next Gen is a stock I've heard you guys speak about in the past, and just as it sort of relates to that supply-demand dynamic, because it's such a huge deposit and potential mine in the future. How do you think that sort of impacts what the commodity price itself does in the future, given the supply it brings online in whatever 2027 or something?
Yeah, that's what I was about to ask you. What is the latest on what they're saying? Because it's been undoubtedly an absolute belter of an asset, and one, the most valuable mining commodity assets outside of a major across any commodity, and one which actually, was one of the contributing to Terra Capital posting some good numbers back in 2015 or 16 when we first took a position in it. How it impacts the market, I mean, if you look at all the in situ uranium, obviously if it all came on, we'd be really swamped. But I think if you look at the timelines of when uranium is on the ASX and the TSX, when they think they're going to produce and when they actually commission and produce commercially, I think there'll be a bit of a lag like there are other commodities. But particularly with uranium, you've got a lot of brownfields restarts that are typically harder than management teams think until they get in there. And then with a deposit like Arrow or Rook I, it's a complicated deposit. And so, I think uranium price reacts favorably in the shorter term before that comes online and starts to impact the market.
Now, lithium's another one I've heard you speak about with regards to Canada too. And it's something we've spoken about quite a bit in the past, specifically relating to the cost curve of how uranium's going to shape up. And obviously there's been a lot of trouble with some of these mines coming on and ramping up and so on. But how do you sort of look at how that cost curve looks in the future? I mean, we spoke about BHP, who decided not to go into the commodity at all because it's just too flat a cost curve. What are you sort of seeing there, and what sort of perhaps time horizons do you have on those investments?
Sorry, on the lithiums in Canada?
Yeah, I think Patriot is
Yeah.
one that I'd heard you
Yeah.
reference, but lithium more generally.
Yeah, lithium's, I just spoke about delays in commissioning, funding, construction, and it's something that we're always cognizant of, because when you're in construction phase, you typically only have negative news. Very rarely does someone come in under cost, under time frame that they suggested, and lithium's been case in point there. I think Canaccord has actually done some very good research on this, looking at forecast production dates versus actual, and I think the average delay is 3 years. So between permitting, which can be a little bit more difficult in Canada, because you're often dealing with multiple First Nations groups, and then the same type of environmental permitting process we have here, plus the trials and tribulations of permitting, of building lithium processing facilities that produce on-spec material. I think that keeps pressure on the supply and demand. We've got that kind of constrained supply versus demand, which, demand continue, EV sales continue to outperform even the most kind of bullish analyst expectations. So, I think even though there's a wave of supply coming, lithium is a relatively abundant commodity geologically. Despite that, I think you still have relatively high lithium prices for the foreseeable future, next few years at least.
All right, we touched on gold a bit, mate, but we'll head back to it. Because you got to disclose all your percentages and top 10 and all that, we wouldn't have as many questions for you. So
I'm wondering where you've got some presentation leaked to you.
I know, buddy Joe. Lucky, you've unfortunately got JD here, mate.
It's all on the website.
I'd be winging it, mate. Now, gold, 30% apparently. So you're obviously, and then
30.
looking at TSX. Is it, gold, is it just because it's always been there, it's always gonna be there, nice and easy to understand, not really a bubble, pretty safe bet to chuck 30% in that?
Yeah, well, 30's maybe a bit higher than what we'd like, but we've had a couple of companies that have gone particularly well, and so they've taken weighting up recently. But just taking a step back on the portfolio composition, because I guess that might be of some value to people. You've got a suite of commodity companies, mining companies. It's kind of not, and most of them are growth oriented, forward looking. If you're looking at base metals or battery metals, more growth oriented. It's nice to have part of your portfolio which is a bit, more defensive. That said, we want to have, usually between 15 and 20% of the portfolio in gold. And then we want to then say, what are the best gold companies we can find anywhere on a risk adjusted basis that we can get exposure to. And so we've had one in Canada called Collective Mining, which has performed really well. Ticker is CNL. They've got, I think the resource now is 3.2 million ounces at 3 grams per ton. Looks like it'll at least double from that. And it's had some absolute belter drill hits, like 300 meters at 3.5 grams and 165 meters at 6.5. It's looking like a real genuine discovery, and one which could get into that significant level of ounces, above kind of 5 mil when it starts to become a really serious deposit. So that's performed well and taken our gold weighting higher. And then we've also had Emerald Resources on the ASX, which has in Cambodia and is run by Morgan Hart, formerly of Regis, and before that Equigold. Both of those, interestingly, are pretty typical of our modus operandi, I guess, where spend the most time assessing is management and their ability to bring an asset through development and into production, and then, or if they're in production, to continue to produce well from. And so in the case of Collective, Ari Sussman is the CEO there. He sold his last company called Continental Gold, sold that to Zijin not that long ago for $2 billion, and then went straight into developing Collective. And so we kind of followed him in there. And then Morgan Hart, everyone knows Regis here in Australia. I think they've built now 7 mines on time, on budget. And the last one, Okval, they built on time, on budget, and during COVID. So, you're dealing with a top team, and that's really what we're looking for, a team that we can back and stick with them and know that they'll do the right thing.
Emerald, it flies under the radar a bit, doesn't it? It's like, God, it's well over $1 billion market cap now.
Yeah, it does. And I think it's because it's got the asset in Cambodia. I mean, it's been a great place. I mean, we don't have any WA gold miners at the minute just because the cost environment's a bit tough. Whereas in Cambodia, I think he's still at between 800 and 900 all-in sustainings. So I think they'll have a second operation in Cambodia, and then they've also got the Bullseye tenements in WA. And actually, they had some announcements. They had an announcement out today with some hits. There's some amazing hits that have come out of that group of tenements. There's been, I don't know, the ones I saw today anyway, 15 at 6 and 30 at 5. Great hits. So as well, the market cap has got up there now, but you also back him to bring these other deposits in as well. You can't bet against him.
And if you look at, there's a discount for companies that operate in places like Cambodia and Africa and everything. But in terms of CapEx at the moment, if you're going to build something anywhere, that's where you'd want it to be built, because the cost environment to do it in Australia is ridiculous. So, because we looked at the Kiaka numbers last week, so I think, off the top of my head, what it was, 300 or 400 million for 8 million tonne, whereas an 8 million tonne plant, whereas the KCGM expansion was bloody 1.5 billion for an extra 15 million tonne. So, cost of CapEx overseas is the one favourable thing at the moment.
Yeah, and staff as well. They haven't had wage inflation in other parts of the world like they have in WA.
Matt, there was another commodity, or another couple commodities I wanted to touch on that you guys have spoken about. So one of them, to start with, carbon credits. How do you sort of think about that? How do you get exposure to that? Like, it's not something we're super across here.
Yeah. Buy green gold.
Yeah, green gold. No Scope 3 emissions. But very small part of both portfolios, but I guess worth looking at. It's an interesting area, and one which we've been coming up on for the last few years. We're invested in development companies, so they develop the projects from which carbon credits will be generated. Not something I'm looking to add to. They went well for a while, and then we've still got some legacy positions. Nonetheless, an interesting space. And if you talk to anyone in the carbon market at the minute, they're super bullish on the next couple of years. So a space to watch, but not one I'm investing more capital into at the moment.
And hydrogen was another one that was sort of, had a lot of chatter 2020, 2021 and so on, and seems to have died off a bit. What's the sort of thesis in those positions?
So I think, the energy transition throws up a lot of opportunities, I guess, and hydrogen, I think, will be part of it. The problem is, in the listed equity space, there's just not that many ways to play it. And of our assessment of all the hydrogen companies out there, not many are realistically going to get into production, in our view. But Frontier Energy, which is in WA, it's just ballpark inland from Kwinana, I guess, a bit further south than that. But yeah, they've got a application and infrastructure that'll mean they'll actually be able to get into production. So we do have a small weighting there again, and that's more company specific because we think those guys are doing a really great job. And then if you look at the Inflation Reduction Act spending, there's huge swathes of capital available for hydrogen projects. So it could be an area to watch, but again, hard to find investable options in the listed space.
And I haven't heard him talk about nickel much today, JD. I'm predicting a bit bearish.
About to pose a question. Are there commodities, and let's chat about nickel as well, that you're perhaps more bearish in the short to medium term on?
Yeah. And I don't want to get in trouble with anyone, obviously. But
Oh, your secret's safe with us, Langers.
yeah,
Yeah, not at all.
so I just think the nickel coming out of laterite in Indonesia with Tsingshan and the like, that although that is relatively high cost nickel production, that part of the cost, that part of the global production is expanding at such a rate that I think it's putting pressure on the entire nickel market. And they have recently talked about producing nickel matte. So that is, nickel to rival that which comes out of nickel sulfide deposits for use in batteries. So there is that. I mean, that's also very high cost, but also something, I guess, to be aware of. And so just on a shorter term basis, we're pretty light on nickel. That said, always if you can find a high quality nickel sulfide deposit anywhere in the world, it's inherently valuable. I think there's just not that many of them.
Mate, JD's done the research on your performance, even, mate. You can't. Nothing is secret today. You're about 4% below Buffett status. So, mate, it's pretty impressive over 13 on years. 15.6% compounded over 13 years. Mate, she's better than the bank.
Yeah. We have been a little bit volatile, but yeah, I mean that's the idea of running a concentrated portfolio. We only run 10 stocks make up 50% of both the green fund and the natural resources strategy, and that does, we think, gives you better results over the medium to longer term, but it does impact short-term volatility. So yeah, I mean, hopefully, Jeremy started the fund in 2010. I joined in 2013, and May 2011 was when commodities really turned down. So, and they haven't looked that good until 2020. So hopefully, in the next 10 years, we'll do better than that, we hope.
When you're long only, and because that's when the volatility comes in, why do companies go long only, and why do funds go long only, and why do other funds go long short?
Yeah, good question. Our skill set is in long only investing. We've never been short investors. That's the first thing. The next thing is that it's very hard to accurately hedge mid-cap miners. Even if you're short, you say you've got a copper stock, you're long the stock and you're short copper, you can end up having unfavorable outcomes pretty quickly. And because commodity prices are impacted by so many macro events and so quickly, you've got to react in no time at all. So I think it is a little bit difficult. Mind you, there are other people in the market, other fund managers. There's, like I was saying before, there's not many resources funds at all. We need them all to get up and perform well and support the industry. But I'm thankful that we're long only all the time. It's hard enough running a fund when you've got an exchange that operates all through the night. Hard enough to sleep. Hard enough to sleep anyway. Let alone if you short something on a bullish day in North America or something.
God, yeah.
Matt, I just wanted to touch on something you just said there again. Sort of the difference between when you guys sort of started the fund, when you joined the fund. How different are commodity markets from now, looking back a decade ago?
Yeah, so I guess the key change is that lack of capex and the unwillingness from the major miners to spend that money on new projects. They're all the major miners got wrapped over the knuckles by the large global investors after 2010, I guess, which was the end of or 2011, which was the end of the mining boom, where, Rio had invested in Riversdale and Alcan, and, there was all those top of the market transactions, which in hindsight looked like poor use of capital when really that should have been returned. And so, the CEOs of these major mining companies still haven't gone back to that real green or even brownfields expansions of significant scale. And so it's the capex in the industry. And, there's a bunch of charts out there showing capex in the mining industry. That's the key thing, really that drives mining commodities production. So that's the key thing. I think other things, ESG is probably the other big change where, we've made changes to our investment process because companies that are doing the right thing on the environmental side also getting lower cost of capital. They're getting economic benefits from doing the right thing. And so for us, it's not just a box ticking exercise. It's, we're assessing companies' ESG credentials because they'll have more favorable economic outcomes in the longer term. More equity participants can buy the stock. But then also they've got a lower risk profile because there's less risk of, an asset being taken off them or increased taxes or whatever the case may be. So they're probably the two things that spring to mind.
Mate, unfortunately, you've done such a great job today that we're going to have you on again sometime, mate. Mate, it's been an absolute ripping chat.
Really appreciate your time, Matt.
I had a bloody ball, mate. Thanks so much for the time.
No worries. Thanks for having me on. I'm a long-time listener of the show, first-time guest. It was great. I love listening to the show pretty much every day. It's great. If I miss something during the day, you guys have got it covered.
Yeah, these boys do. Yeah, and I'll keep the knee slappers coming, mate. Don't you worry about that. Mate, too easy. Mate, we got to come over to Sydney soon because tell you what, I noticed a lot of people in Sydney hadn't even heard of us yet when I was over there, so I think we've got to do a bit of a road show.
Bit of promo on
Absolutely.
the cards.
Yeah, and I think Gigi sent you that text about a mate with a pub over here.
Yeah.
There's that option, potentially.
Oh, I can't wait. Mate, when you come to Perth, let us know.
Yeah.
We'll do some Swan Draft, Cobber.
Would love that.
Thanks again, Matt.
Good on you,
Easy.
Wangers.
Cheers, boys.
The information contained in this episode of Money of Mine is of general nature only and does not take into account the objectives, financial situation, or needs of any particular person. Before making any investment decision, you should consult with your financial advisor and consider how appropriate the advice is to your objectives, financial situation, and needs.